The first one Lakh investment plan every Indian should know. Most Indians never reach their first 1 lakh rupee invested, not because they don't earn money, but because they never build a system. Salary comes, expenses happen, and investing becomes next month. Month after month, year after year, and suddenly 5 years pass. No investments, no assets, no financial momentum. But here's the truth most people don't realize. The first 1 lakh rupee is the hardest money you will ever build. After that, things change. Your investments start working. Compounding begins. Confidence grows. So the question is not, how do I become rich? The real question is, how do I build my first 1 lakh rupee investment system? Because once you cross that line, wealth stops being impossible. It becomes mathematical. Let's break it down, calmly, clearly, step by step. Disclaimer right after hook. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Build the foundation before investing. Most beginners skip this part. They open a trading app, buy random stocks, and call it investing. That is not investing. That is speculation. Before your first 1 lakh rupee investment, you need a financial base. Emergency fund first. At least 3 months of expenses. If your monthly expense is 20,000 rupees, your emergency fund should be 60,000 rupees. Keep it in a savings account or a liquid mutual fund. This protects you from panic selling because markets fall, jobs change, life surprises everyone. Protection first, investing second. Step 2. Start with SIP investing. SIP means Systematic Investment Plan. Instead of investing large money once, you invest small amounts regularly, every month. Let's say you invest 5,000 rupees per month in a good index mutual fund. After 1 year, you have invested 60,000 rupees. After 2 years, 120,000 rupees invested. But something powerful happens. Markets' ups and downs average out. You buy when markets are high, you buy when markets are low. This is called rupee cost averaging, and it removes emotional decision-making. SIP builds discipline. Discipline builds wealth. Step 3. Understand asset allocation early. Do not put all money in one place. Diversification matters. A simple beginner allocation could be 60% equity mutual funds, 30% debt instruments, 10% gold. Example. If you are building your first 1 lakh rupee, 60,000 rupees in equity funds, 30,000 rupees in debt funds or fixed income, 10,000 rupees in gold ETF or sovereign gold bonds. Why this matters? Equity grows wealth. Debt stabilizes wealth. Gold protects during uncertainty. Different assets behave differently, and that balance reduces risk. Step 4. Understand market risk cycles. Markets do not move straight up. They move in cycles. Bull markets, bear markets, excitement, fear. In India, the Nifty 50 has seen many crashes. 2008, 2009. But long term, it still grows. This teaches one powerful lesson. Time in the market is more important than timing the market. Your first 1 lakh rupee should not depend on guessing. It should depend on consistency.
Step 5. Rebalancing your investments. As markets move, your allocation changes. Example. Your equity grows fast. Your 60,000 rupees equity becomes 80,000 rupees. Now your portfolio is unbalanced. Too much risk. Rebalancing means adjusting back. Sell some equity, move to debt or gold. This keeps risk controlled. Rebalancing once a year is enough. Calm, systematic. Step 6. Understand taxes early. Taxes quietly eat investment returns. In India, equity investments held more than 1 year are taxed as long-term capital gains. Currently, around 10% above 1 lakh rupee profit. Short-term gains are taxed higher. Debt investments have different tax rules. The point is simple. Long-term investing is more tax efficient. Frequent buying and selling reduces returns. Patience protects profits. Step 7. Avoid the common beginner mistakes. Mistake 1. Chasing hot stocks. Mistake 2. Listening to random tips. Mistake 3. Panic selling during market drops. Mistake 4. Checking portfolio every day. Wealth building is slow, quiet. Most successful investors are boring investors. They follow systems, not emotions. Step 8. Scale after your first 1 lakh rupees invested. Once you cross 1 lakh rupees invested, momentum begins. Increase SIP gradually. 5,000 rupees becomes 8,000 rupees. 8,000 rupees becomes 12,000 rupees. Every salary increase investments too. This is called step-up investing. Over 10 years, even moderate SIP growth can build 15 to 25 lakh rupees portfolios. Not through luck, through consistency. Step 9. Build the long-term mindset. Wealth is not built in 1 year or 2 years. It is built across decades. Your first 1 lakh rupees is not the destination. It is the ignition point. The moment when money starts working for you, instead of you always working for money. And the people who win financially are not the smartest. They are the most disciplined. One day, your portfolio will cross 5 lakh rupees, then 10 lakh rupees, and you will look back at the moment you built your first 1 lakh rupee system. Not luck, not shortcuts, just calm discipline. Future you will be grateful because today you chose structure over impulse, consistency over excitement, and patience over noise. That is how wealth quietly begins.